Welcome guys, welcome to another episode of Funds Ki Baat ICICI Direct के साथ. Today we have Mr. Manish Gunwani with us. He is the head equities at Bandhan AMC. Manish is an engineer turned fund manager. He has done his engineering from IIT Madras and MBA from IIM Bangalore. It's an absolute pleasure hosting you, Manish.
Thanks for having me.
Yeah, so you have more than 2 decades of experience in the market, and you have your earlier stint with Nippon, and now you are with Bandhan. So we'll just talk about your journey first, and then move on with the equity side and the market side. So could you just help us out with your journey?
It's interesting that even when I was doing engineering, I kind of lost interest in engineering and started following stock markets. So the way it kind of played out was my father is a doctor, and in the late 70s, there were these forced listing of MNCs,
Yeah.
and a lot of doctors got these pharma shares, Glaxo and all that. So I was doing engineering in early 90s, and I used to do some filing work for these share certificates. That time we had
Yeah,
physical share
yeah.
certificates. A lot of
Yeah,
the young
yes.
people will not know that. So when I was doing all this work about cataloging all these share certificates and seeing what has happened to the prices over time, I realized that, let's say Glaxo, my father got 117 shares, which was 170 rupees free. And by 92, 93, it had become 3 lakh. So I felt that instead of becoming an engineer, if we can make money this way, this is a better way of making money. So the logical thing was then to go to IIM because finance was there,
Yeah.
right? So I went to IIM, I did finance, and since then I've broadly been in stock markets. Okay, the other passion I have is technology, so I've also done technology entrepreneurship. And part of it was when I came out of IIM, I became a software analyst.
Okay.
And then I saw the boom of 95 to 2000. So I felt again that,
Let's do
there's
this.
so much momentum. We should try something in entrepreneurship. But yeah, largely I've spent my career first on sell side primarily, which is basically on the broking
Yeah.
side, advising clients,
Yeah.
doing equity research. And in 2010, I joined ICICI Prudential Mutual Fund on the PMS side.
Okay.
That was my first buy side
Yeah.
job. And yeah, since then I've been on a buy side as a
Absolutely, yeah.
fund manager.
And I think your earlier journey is complete, like makes sense because right now we are at the cusp of finance and tech combination.
In fact, interestingly, I have been called a bubble analyst because I was a software analyst in 2000 when the
Dot
software
com,
bubble
yeah.
broke. And in 2007, I was covering real estate. So people have said that you've seen a lot of bubbles.
Manish, we have seen many cycles in the market. Like
Yeah.
we have seen many all-time highs and a correction from there. Right now, we are in the all-time high territory, and a lot of people have this question: that where are we headed? So some may say 21,000, some are expecting a fall towards 18,000. What is your take on the market right now, and do you see any volatility kicking in near term?
So first of all, I find this phrase all-time high quite strange because if India's nominal GDP is growing 11-12%, I think 90% of the time we will be at all-time
Right.
high, right? So this all-time high is not so much of a concern. So the way I'm looking at the market is, one is tactically you need to be cautious because we use some of the tactical indicators in, let's say, a balanced advantage fund model also.
Yeah.
And that is saying that whether you see credit spread, you see volatility indicators, they're too low today. So they tend to be mean reverting.
Right.
So I think some of these tactical indicators are definitely saying that there can be a bit of a consolidation or correction. More medium term, I think I have a fairly optimistic view because my view is that if you see global capital market
Yeah.
cycles, the single most important factor is the way dollar behaves. So
Yeah.
when dollar appreciates against other currencies, we typically have a bear market
Right.
or bear market like conditions.
Yeah.
India में pure bear market doesn't sustain too
Yeah.
long, but yeah. So when dollar appreciates, generally liquidity is low, returns are less, and when dollar depreciates, like 2002 to 2008, that is where the big money is made,
Yeah.
big returns come. And my sense is the dollar after 10, 12 years of being strong is more likely to depreciate, and that I think will generate good liquidity. And this time, I think if you compare it to the 2000 to 2010 cycle, where broadly the dollar was weak,
Yeah.
the big difference I think this time is that at that time the number of emerging markets which did well was very high. So China did well, Brazil did well, South Africa did well, India did well.
Yeah.
But I think today it's not a great thing for the world, but as an Indian, I think there is a silver lining that there are not too many emerging markets which can absorb capital because of geopolitical thing or demographic issues or debt issues. So if you see whether it's China, Saudi, South Africa, Russia obviously out of the index right now. So the number of emerging markets where I think big asset allocators can say that, okay, this is a country over 10 years, I can trust that,
Yeah.
it will grow at a steady pace. It has institutions where the law of contract will be honored, and there'll be level-headed decision making at all levels of the government. I think there are very few countries like that. So in that sense, I do think that the proportion of flows which will come to India in emerging market flows will be quite high.
Yeah, and again we can see that since March 2023
Yeah.
as well. A lot of funds have, like, we've seen a good inflows from FIIs and FPIs in Indian markets. I think it's more to do with the political stability and how we are placed globally.
Yeah.
As well. So my next question is regarding the global conflict, because in 2022 we have seen the Ukraine and Russia
Yeah.
war, and recently we've seen the Israel-Hamas thing. So do you think this conflict will have some impact on Indian market? Because at some juncture, India will have to take sides, and we cannot be away from the global class, right?
Yeah.
So what is your take on this?
So I'm fairly optimistic that this conflict will be kind of controlled. See, obviously, the Israel-Palestine question goes back very long way back, right? The thing is, at this point, sorry, at this point, we have U.S. presidential elections next year. The US inflation has gone, and global inflation has gone through a very high phase.
Yeah.
So I'm sure that the developed countries in the West, they don't want very high inflation from here. They don't want oil price to go to 120 or whatever. They don't want any big escalation of either Ukraine or Israel wars, because that will obviously impact election, right? And to that extent, I think the policymakers will definitely do their best to try and control these conflicts. Now, is there a tail risk that in spite of policymakers' actions, this blows up? And those kind of random tail risks are always there. But you have to just have a base case and live with the probability that the base case works out. So just when I see the incentives that do the Western powers have an incentive that this escalates, or even the Arab states, Saudi, Iran, Iraq, they also, I don't think, will want this to escalate, because we live also in a world where nuclear powers, nuclear arms are there.
Absolutely.
That itself acts as a bit of a deterrent. So I'm just having a base case that this doesn't go into a very high involvement conflict.
Absolutely. So this, my first question was to the global conflict, the volatility which it may impact the volatility in markets. We are moving towards a very important phase in Indian state as well, because we have the general elections next year, and we have three important states going to vote. So do you see that this event having an impact on the markets? And if somebody who wants to enter the market right now, how should one place their bets in this scenario? Because we have a global conflict, plus we have a political elections coming up. So these two events can kick in a lot of volatility going ahead. So what is your take here?
So I do expect volatility from the perspective that, first of all, sitting in Bombay, we've not been good at predicting elections. Right. So if you take the last 4 elections, there have been 2 elections where market has done 20% circuit.
Right.
And the other 2 also, we've never been able to predict to level of within 30-40 seats. I mean, it's always been
Yeah.
more than that, right? So to that extent, I think maybe sitting anywhere in India, it's difficult to predict how elections behave. The other, I think, big difference is also that maybe in the last 2-3 elections at least, we've not gone to the elections with PSU valuations or capital good valuations being so high.
Yeah.
Right? So, a lot of people believe that the election will not have an effect because historically they've not had. But I feel this time they probably can create a bit more volatility based on the result, because the PSUs in defense stocks, capital goods stocks have done well. They are trading at fairly high multiples. And they are policy dependent, right? I mean, the government's policy definitely does affect these sectors. So, now obviously, if the result is as per what market wants, it will not have an effect. But yeah, I think the volatility around the result will definitely be there.
Absolutely. And the companies which are policy dependent and have a higher valuation can see a lot of volatility there.
Yeah.
That's the thing. Absolutely. So Manish, this was about the global conflict and the Indian. One thing I want to ask about is the sector. Like we have, like for example, IT sector. We have seen a lot of corrections there since the calendar year 2022 began, and the advent of ChatGPT, AI, and all these stuffs are also having an impact there. So I just wanted to ask you that one sector that you would be betting right now, and one sector you'll be like careful of investing at this juncture.
So maybe I'll talk about a couple of each. So one on the positive side is the entire value chain on power and energy capex. I think that theme has multiple positives, that there is a demand supply gap in India building up. So you need power capex in India.
Right.
There is also a very synchronized capex towards renewables globally, which also means that you have to invest in the grid. So there is a lot of export opportunity for some of the equipment makers in India. And added to that is that in that export opportunity, China has been a big supplier, and given the geopolitical context, there is a good chance that a lot of Indian companies can get market share from Chinese. So there are a lot of tailwinds in that theme. So that is one theme we have reasonable overweight on. The second theme is on mass consumption. Now this COVID and inflation twin shocks over time we think will go off, and also there is an election heavy year. There tends to be a lot of formal and informal spending around elections in rural areas. So some of these segments related to rural consumption, I think we have reasonable exposure to. On the underweight, or where we are concerned, we remain underweight on IT. Because while US economy has done better than what we thought this year, given the way the rates are shooting up, we do expect, or we think there is a high probability that US may go into a recession maybe next year. And to that extent, while IT last 2 years hasn't done well, but on a 5-year basis still has done pretty okay. We do think that the risk reward is not great even today. The other underweight, which we've been having for a fairly long period of time, is the whole consumer staple plus consumer discretionary, because I think when interest rates were very low in 2017 to 19, these stocks got re-rated to a level where even today there may have been a price and time correction in some of them. But in general, we think that the multiples are too high, especially given the fact that globally interest rates have gone up so much.
Absolutely. And talking about IT sector, I think one catalyst is missing from the management. So there's a lot of uncertainty in the management commentary as well, and few news of like Infosys, who's been a mass recruiter for every college, won't be recruiting freshers this year, and that is a big statement to me.
Actually, this quarterly results, if you see, the headcount reductions have been quite significant. But yeah, I think we're waiting for US GDP to collapse to be positive on the sector, which is not happening.
Okay, I would not comment on that. Okay. So Manish has spoken about sectors that you're bullish on equity side, the volatility and everything. So this is on the equity side. I want to take you to want to ask some questions on the fixed income side. I know you head the equity desk at
Yeah.
Bandhan AMC, but if somebody who wants to manage his portfolio, wants to create a portfolio, it's said that you need to have a mix of both equity and debt in both. And whenever volatility comes in, I think debt is your soft landing place, which
Yeah.
absorbs the volatility there. So if somebody wants to make a portfolio today, what would be an ideal mix that you would suggest? I know there's no one fit all
Yeah.
measure, but still.
Yeah, again, a lot of customization based on risk profile, time frame, and all. But I do think that probably be 60-40
Okay.
in equity still. Um, Look, I think long-term duration can make money from here. There's a very good chance
Yeah.
because India 10-year yield typically tends to trade in that 6.5 to 8.5 zone,
Yeah.
and we are kind of midway there. And globally, I do think long-term growth is going to be soft,
Yeah.
given that most developed countries have aging populations and high level of debt. So you could say 7.4, 7.5 is a good entry point for the 10-year yield. But I think the most fascinating question I think is global at this point of time, that where do US 10-year yields go? Because even if India's inflation is within control,
Yeah.
if US 10-year yield goes to 6,
Yeah.
there's no way that you'll make money on India at 7.5.
Yeah.
Not no way. We never know what happens, but unlikely,
Yeah.
right? So I think the fascinating question at a macro level today is the US scenario is very tricky at this point, as I believe that. See, usually in business cycles, as interest rate goes up, economy slows down, and then you cut rates and starts all over again. But
Yeah.
there is one catch this time, that when the economy is at the peak, which is where US is today, your fiscal deficit actually at the lowest, because at the peak your tax revenue are the highest.
Yes.
And that's supposed to mean that when the economy starts slowing down, you get both monetary and fiscal
Yes.
stimulus, that rates get cut and government starts spending.
Yeah.
But the whole issue with this cycle has been that, and this is actually global as well, that even if you see India in a normal year like FY24, our fiscal deficit is 9%,
Yeah,
which is quite high.
Yeah.
But specifically in US, because the numbers are so big there, you're tracking about $2 trillion of
Exactly.
deficit, right?
Yeah.
Now, the thing is, will they try to engineer, or will they be okay if the economy slows down sharply? Because when an economy slows down sharply, fiscal deficit tends to shoot up.
Yeah.
So, at one level, you could argue that for the US, it's better compromising on inflation and running this current nominal GDP growth of 6-7% for some time,
Yeah.
so that the deleveraging of the government happens.
Yes.
So that trade-off, how much to fight inflation, because the more you fight inflation, the worse the government balance sheet is becoming.
Yeah.
That trade-off, I think, is the real question. Because if they choose to fight inflation from here and US 10-year yield goes to 5.56, then in India also, I think very difficult to make money on duration in fixed income.
Right.
Accrual is okay. But if US decides that sustainability of the government debt is becoming an issue, and it starts becoming dovish on the monetary side, I think that can help all asset classes, including
Absolutely.
fixed income. We have to take a call on that.
Yeah, absolutely.
And in which case, I'm saying that equity is better, because if US turns stimulative, I think equities will give you a bigger jump than
shoot up. Yeah.
than bonds.
Exactly. And I think the conundrum for US is right now the growth over inflation, and getting into an election year where stats say that the
and
current
there's
government,
a political angle that you're so close to election.
Exactly. And plus the current government is not in favor.
It's like they're trailing in opinion polls,
Exactly.
I think. Yes.
Exactly. So Manish, I think I've asked major questions, but one last question that I wanted to ask is, that we are focusing on the buy side of equities, but the important part is the sell side. And when do you, like, selling is also
Yeah.
an important part of this whole pack. So when do you decide to sell a stock?
So I totally agree to this discipline on selling, because honestly I'm not a big fan of buy and hold investing. So I think initially our icons used to be Warren Buffett kind
Yeah.
of buy and hold investing, but today I would think that Peter Lynch or George Soros, who believe in churning portfolios, I think for me they're more relevant, to be honest. Because I think what has happened is, as markets have become more efficient,
Yeah.
the pricing discovery is faster.
Yeah.
So the luxury of getting into a private bank in, let's say, mid 90s and holding it for 20 years while the bank kept growing 30%, that kind of pricing inefficiency is not there today. So the cycles are getting shorter because pricing efficiency is faster. Macro seems to change faster.
Yeah.
So I do believe that you need to churn funds, you need to churn portfolios. And in that context, the question is, what you ask, how do you decide what to sell? So one is the more simple answer, that you sell on valuation.
Yeah.
But honestly, I don't think that has a very, very high probability of success, because as one investor said, the real money you make is in bubbles. So if you let go of a bubble,
Absolutely.
how will you make money?
Absolutely.
So over time, as a fund manager, I mean, every person will have a different view on this. My selling discipline is still, honestly, still valuation is probably 50-60%.
Yeah.
But a bit is behavioral and technical. So I don't necessarily sell saying 20p stock has become 30p. If earnings are going at 30% and looks like next 2 years, 3 years, it may still grow. So one is that. Two is, I think I've started looking at selling from a market cap perspective more than a valuation perspective. In the sense that price to earning and price to book is one thing. But the slightly more structural views on selling, where if you feel that, for example, the market cap of this stock looks too high versus similar stocks in global sectors, or with, if you compare it to other sectors, where some top 4-5 stocks of a sector combined will be less than this stock.
Yes.
I think those are better and more decisive selling indicators, rather than just saying a 25 PE stock has become 30 PE.
Absolutely.
And the thing is, you also learning to factor in the role of passive in active style. That what I figured out, or what I believe now, is that if you have the same earnings trajectory for two stocks, you should buy the smaller stock, because what tends to happen is the bigger stock is already in indices like Nifty, MSCI, whatever, right? Whereas if it's the smaller stock, it keeps coming into the indices and a lot of passive money keeps buying it. So what I've seen is, for the same earnings trajectory, you get a faster re-rating in smaller stocks. So maybe I'll be more active in selling a larger stock, but if it's a small cap, I tend to keep it, even though I think it's fairly valued. Because I know some passive people will come and buy it off me.
Absolutely. I think that's what many people track. Like, they track the sector leader, and if that's that's on the way to move up, people buy the small cap one, so that you get a higher return and in short span of time compared to the leader. I think that's one of those things. Manish, one thing before we end this is, like, any one fund from Bandhan AMC that a newbie can look at, because we spoke about, so any a hybrid fund or a multi-cap or a multi-asset fund or something.
So I think if someone who's coming into equities and has a very long time frame, I'm a structural bull on small caps. So I know that I'm tactically saying equities, you need to be cautious. But again, that's why I'm saying that someone needs to have a very long time frame. But I think that, again, this goes back to 100-year history. There's data for 100 years that when economies have grown, they're fastest in GDP, like Japan from 1960
Yeah.
to 1990, or US from 1900 to 1950s. The small and mid caps have outperformed because you see creative destruction, you see new industries emerging, new management teams emerging. And therefore, I think that even if it's a new person who's coming into equities
Yeah.
but who has 5-10 years on his side or her side, then they should look at our emerging businesses fund.
Emerging business fund. So viewers, you can look at emerging business fund at Bandhan AMC. So that was all that I had to ask. But before I end, we spoke about markets, global scenario, geopolitics. What do you do when you are out and not looking at these news? So what do you do? Do you like reading, or what are
So
your
I've been a
hobbies?
sports buff.
Yeah.
Unfortunately, with age, I've stopped playing so much. But I follow a host of sports: cricket, football, English Premier League, everything. So that's the first hobby. Second is again maybe with age becoming more spiritual and meditation occupies a lot of time. Third is, yeah, I read a lot, even not related to
Markets.
investing.
Yeah.
So recently, over last 5-6 years, I've got massively interested in history and sociology and all that. So yeah, I read a lot of vague books on history.
Yeah.
Actually.
One book that you can recommend for our viewers?
So I just read this Amitabh Ghosh's book on opium history, and it's quite fascinating that if you see the names of Bombay streets to
Yes.
how BHP Billiton was founded,
Yes.
it all links back to opium so much, right? So
Absolutely.
a fascinating book actually.
Nice. So it was an absolute pleasure hosting you, Manish. Thank you for your time.
Thanks
Thank
a
you,
lot.
viewers.
Please note, mutual fund investments are subject to market risk. Read all scheme related documents carefully.